All right, let's dive into this. We received a really fascinating blueprint aimed at growing a Canadian RDSP and a TFSA to, well, a pretty staggering $10 million.
Yeah, staggering is right. What's really interesting is that the standard approach, the one most advisors would suggest, it projected maybe $750,000 over 20 years.
From about $10,500 in personal contributions each year.
Exactly. So bridging that gap, that massive $9.25 million difference, it demands more than just saving more. It requires a whole different investment mindset, a paradigm shift, really.
So let's break down that math. Hitting $10 million in 20 years means you need, what, a 33.7% compound annual growth rate, a KTGR of nearly 34%?
Precisely. And when you think about historical market averages, they're usually around maybe 10%, give or take. So 33.7% is way, way out there.
It raises the obvious question then, how could anyone possibly achieve that? I mean, is it even feasible?
Well, that's what we dug into. The framework we analyzed hinges on three, let's say, core pillars. First, using leverage strategically. Second, allocating funds to high return but riskier alternative assets. And third, active, very disciplined portfolio management.
Okay, let's unpack those. But first, maybe just quickly touch on why these two accounts, TFSA and RDSP, together. What's the synergy?
Good point. Think of the TFSA as your growth engine. All gains are tax-free, so it's ideal for assets you expect to shoot up. The RDSP, meanwhile, is like a secure foundation.
Secure because of the government help.
Exactly. You can get up to $90,000 in government grants and bonds.
Yeah.
That's essentially free money boosting your base. Really powerful, especially early on.
Okay, pillar one, leverage. Borrowing to invest sounds inherently risky. How does that work in Canada, and what are the big watch-outs?
Right, so leverage means using borrowed money. It definitely amplifies potential returns, but crucially, it also amplifies risks. Big time.
Yeah.
In Canada, you've got options like the Smith maneuver.
That's the one converting mortgage debt.
Yeah, turning non-deductible mortgage debt into a tax-deductible investment loan. Or you can go with direct margin investing, borrowing against your portfolio. But the danger is real.
How so? What's the specific danger?
Leverage magnifies losses disproportionately. A 10% drop in your investment could wipe out a much larger chunk of your actual capital. It can lead to margin calls.
Where your broker basically demands more money. Right.
Right. Or worse, if things go really south, potential bankruptcy. It needs extreme caution. The key isn't just borrowing, it's managing that debt actively as part of the strategy.
Makes sense. Okay, moving on. Pillar two, alternative assets. This is where it gets really interesting. You mentioned private equity, venture capital.
Exactly. These are investments outside the traditional public markets. Think investing directly in private companies, maybe startups. Historically, they can offer much higher returns and diversify your portfolio.
But they sound exclusive. Are they accessible?
Increasingly, yes, even in Canada. There are platforms now, but typically for what they call accredited investors. That usually means meeting certain income or asset levels. Basically, people the regulators think can afford to lose the money.
Afford to lose? That sounds like a significant trade-off. High reward, high risk.
Definitely. The main trade-offs are, first, illiquidity. Your money can be locked up for, say, 5 to 10 years, maybe longer. You can't just sell easily.
So no quick access if you need the cash.
None. And second, there's serious capital risk. Some of these, especially early-stage ventures, could go to zero, complete loss.
Wow. So picking the right ones, or rather the right manager, must be critical.
Absolutely paramount. You're betting as much on the fund manager's skill, especially their ability to exit investments profitably, as you are on the companies themselves.
Okay, this plan we looked at, it specifically mentioned focusing on AI and tech, right? High growth potential there.
It did. That sector obviously has huge global potential. The blueprint suggested looking at, say, Canadian public companies like Kinaxis, checking their growth forecasts, even watching insider activity.
Like executives buying or selling shares?
Yeah, but interpreting it carefully. Insider selling isn't always a red flag. Could be for personal reasons, but a lack of insider buying when things look good, that might be more telling,
Gotcha. So putting it together, the TFSA becomes like a hyper-growth engine using leverage and alternatives, while the RDSP stays a bit more grounded.
Kinda, yeah. The revised blueprint we simulated, using these aggressive strategies, targeted a 20% CAGR. Still very high, but maybe more attainable than 33.7%.
And what did that simulation show? Did it reach the $10 million?
It got closer, around $8 million in 20 years. A huge jump from the $750,000 conventional path, but still shy of the $10 million mark. It shows the potential power, but also the difficulty.
And this leads to the third pillar, active management. This isn't just buy and hold.
Not at all. It's constant vigilance. You need extreme discipline, rebalancing regularly so you don't get too concentrated in one thing. And, crucially, resisting that urge to panic sell when markets inevitably dip. That's often the hardest part.
Holding your nerve when everything feels like it's collapsing.
Exactly. It requires a plan and sticking to it even when it feels uncomfortable. Portfolio hygiene, constantly reassessing.
So wrapping this up, hitting $10 million is, well, incredibly ambitious. It demands a really aggressive, high-stakes approach.
Absolutely. Which brings up a crucial point for anyone listening. Given the substantial risks we've talked about, leverage, illiquid alternatives, you absolutely must consult a qualified financial advisor before even thinking about a strategy like this. This is not DIY territory for most people.
A really important warning. So the final thought maybe for you, the listener, how do you personally feel about balancing that kind of extreme ambition with the very real, potentially life-altering risks involved? It's definitely something powerful to reflect on for your own financial path.